Yo, how you guys doing? Thanks for clicking on this video. This is my first video on this channel. Of course, I'm going to be going over so much more. But my first video, I wanted to go over MMXM, as I do believe that this is the best method, the best trading style to use on the markets. So this video might be a little lengthy, as I do want to go over everything. I want to give like all the details and intricacies of MMXM, and if I do miss something, please tell me, and I will make a video on it. Or if you just want me to go over something a little bit more, just let me know. And first of all, I do want to make sure that you have a pen and a paper next to you. This is because honestly, I'm gonna go over all this off the top of my head. I don't have a script. I don't have a complete plan of what I want to talk about, so I might be just a little disorganized. But of course, I will try to make it as organized as possible and make it fluid, make it flow. No? So let's start it off, yeah? So what is MMXM? Sorry for stuttering. So what it stands for is Market Maker X Model. The X can be buy or sell. Market Maker buy model or Market Maker sell model. So to give you an illustration off the bat, use this. So what is a Market Maker buy model, right? Oops, go like this. Something like this, just to draw it out real quickly. So the buy model is this part right here. This is the buy model. Let me change that color. This is the sell. This is the sell. And this is the buy. So of course, when your bias is bullish, you will be looking for this part and use this left part. They call it the curve. The sell side of the curve and buy side of the curve. You want to let sell side form a structure, yeah? And come into the point of interest, POI. Write that down. Let it form a structure, and then it will commence the buy model. And of course, in inverse, this would be the sell model, and you would want the buy on the left side. This doesn't mean you should be trading both sides. When you have a bias, you want to wait for your side of the curve. And just let the left side of the curve form. Just let it be. Because if you're too early, like let's say you got your POI, right? But you didn't let a structure form, right? Take all these little things out, and you just put a buy entry right into the POI, just like that. I'm sure most of you have seen the market do this. Something like that. Or it'll consolidate. Oh, oops. Consolidate, giving you some, even a little bit of profit, and then just boom, just crashes under. This is why you need to let a structure form first. So that's a little illustration just off the bat, and of course it's not with all the details in it, of course, right? So I want to go over the foundations of MMXM, or foundation, I think I should say. First, it'll be OHLC/PO3. Secondly, it will be let me see, ERL/IRA. And the third, this will be IPTA. And then fourth, it's gonna be time. So for the beginning part of the video, I'm gonna go over these. So to start off with, OHLC and PO3. So what does OHLC mean, or stand for? Open, high, low, close. PO3 is power of 3. Take out these lines. Okay. So how can we use this in an MMXM model? Like I said, if you're expecting a bullish day, right? Let's see, where's the box at? Okay. Oh, and by the way, the beginning part of this video, I'm going to be doing illustrations, so it's for your notes. And then in the later part of this video, I'll be going actual price movements, like on the actual chart. So this isn't going to be just all illustrations and just, oh, take my word for it. I'm going to show it to you and show that it actually does happen and it does work. And it's very strong. Let's make this green, because most people have green bars for bullish. Okay. So you're expecting this to happen on the day that you're trading, right? So where is the open on a bullish candle? It's right here. Oops. Okay. Make it a little thicker so it's nice and visible. Open. Is it not in your best interest to buy down here on this wick? You know, just to have an illustration for you. This will be your trade, right? This is what you would love to have, right? And then let me see. This is your high. Well, first let me make a wick. I'm gonna make it a little bit more realistic. This is your high of the day, and this is your low. And then this is your close, where the market closed for the day. Most commonly, you will see some type of, make that, oh, what the heck? I'm not that good at trading view. You will see some type of MMXM form down here. We're going to be buying here under the open of the candle. The first thing you need to know is the open of the candle. Very important. I know that some people have a little confused with the 12 o'clock midnight opening. They call this the true day opening because on the chart it says at 12 a.m. You know, of course, before 12 a.m. it's Monday, after 12 a.m. Tuesday. But the thing is that this 12 a.m. is inside of the candle, right? It's inside. What you really want to be using is it. Well, if you're using the 24 hours, so I have mine set the New York. That's what most people use when they trade ICT. And I have the 24-hour format to make everything a lot more simple. The 18 o'clock open, way stronger than a 12 a.m. open. I'm going to be going over this later on in this course. I call 12 a.m. Barometer time, and also called 18 o'clock open a barometer time also. It just means that, let's say that this is 18 o'clock, right? 18 o'clock open. This candle will have an 18 o'clock open, and you want to be buying under the 18 o'clock open candle, or just the time. So if you're buying under here, and you're expecting a bullish day, you can have a very great day, right? But if you buy under 12 a.m., you might have a later entry, like somewhere in here, right? But the best is right here. And you do want to be using this 18 o'clock open for the rest of the trading day. So that's the OHLC. And it's basically, I have a slash PO3 because it's basically the same thing. Power 3, it just means, you know what I like to do? I like to think of it as a triangle, yeah? Because let's say that this 18 o'clock open is your baseline for your triangle. You want to be buying under that baseline. And this is a MMXM right here too. That's what's happening in this wick. So this buy is right here, sells right here. And you can use this buy up to over here to where your other POI is at, right? This might be another FEG up here, or another order block, or just a structural high or low. Okay. It's not erasing. All right. Let's move on to the second. The ERL, IRL. This is one of the, how do you say it, strongest parts of the MMXM. So basically, what is ERL? This means external range liquidity. What does this mean? It just means that it's a high or a low. So we're buying into this FEG right here, right? This is IRL. I'm gonna go over that a little bit. Goes into IRL. The next objective is ERL. So yeah, going to be trading IRL to ERL. This is one of the most strongest way of using ERL, IRL. Of course, there is also, put this back, there is ERL to IRL, right? Because before hitting this, coming to this FEG right here, it took out the ERL, this little high right here, manipulated it, expanded down into what? IRL. And I'm sure you can already see the MMXM pattern in this. Buy side curve, sell side curve. So for ERL, I'll just put structural, high or low. All right, what is IRL? It means internal range liquidity. So this can be your FEGs, order blocks, breaker blocks, your reapers, just some ICT terms. But basically all of these terms right here is IRL. ERL is strictly structural high or low. IRL is strictly FEGs, OBs, and what other methods. But of course, the ones everybody knows, strongest FEG, OBs, and BBs, breaker blocks. Oh, hold on, I don't want to go over this yet. I want to erase that yet. So never forget the pattern. ERL towards IRL. If you're trading from the IRL, you want to aim towards ERL. This is the cycle right here. Cycle. This pattern is the holy grail of the markets, to be honest. If you understand the ERL, IRL very, very well, then your trading is going to be very smooth. But of course, there's a lot more to it, right? Like entries, how to confirm it, stuff like that. I'm going to go over everything. So, next up on the list for foundations, It's IPTA. This means intermediate price delivery action. Oh, sorry, somebody's calling me. Hold on. Put the ringer on. Or it can also mean interbank price delivery action. It just basically means how price moves in the markets. Price has phases. Going back to the PO3, there's only 3 phases in the markets, right? There's accumulation, expansion, reversal. There can be an argument made for there's only accumulation and expansion. There's more arguments that there's different phases. But these 3 is the most known and easiest spot. Accumulation, expansion, reversal. Basically, give a quick illustration on this too. Accumulation is consolidation. Expansion is when it expands. It's a thing. Where does it expand to? So going back to the point we were talking about earlier, the ERA IRA. Let's just say the price expanded to an FEG. Just say there's FEG right here somewhere. You see price expanding up to an FEG, and most likely you're going to see a reversal back into the range that was made. Let's go over it real quickly. Just real quickly. What is a range? And a little subtopic. What is a range? Range is just a high and low. So where's the range in here? The range is from this high to this low. Here's the thing. Why this low and not this low and not this low? Because this low right here, put a box on that to highlight it. Oh. This is the low that broke structure. This low was the one that broke all the structure right here to the left. This is the accumulation phase. This low did not break anything. This low, well, in this illustration it broke, but of course it's my accumulation phase. It's not a very noticeable expansion, right? It came back down. This low made the expansion. So your range is from this low that broke the structure and this high, that is the high of the expansion. So this high is what most people try to predict, but it's not what you really should be doing. You don't really want to predict where the high and the low of the day is going to be. If you just do that, you're just going to destroy your accounts. It's a lot easier to let the structure form clean this back a little bit, right? Say an FEG came in here, right? It's back into the FEG and comes back down. And yes, this little low right here is an ERL2. The FEG is the IRL, right? So just this little piece of price action right here, this little snippet right here, you can make a lot of money from this IRL to ERL. But of course, you want to catch the big move. You want to identify the ERL that broke the structure and sell it all the way down. Does this always happen? No, it doesn't always happen. Most of the time, it'll hit the IRL, ERL, come like right here, reverse again. Why does this happen? Because in this expansion, it's obviously going to be a liquidity void or an FEG in there too. And guess what? Oops, we got the IRL. That's IRL to ERL. So yeah, you can see that MMXM can be fractal. Even in the smallest parts of the market, it's always going to happen. I don't know why it's not erasing. Hold on. Of course, I'm going to go over the ranges a little bit more too. Just want to start off this video with some basic information. Alright, 4 time. So here, just to get it over with, I'm going to give you barometer times, what they mean, and the times you should be looking for setups, especially on turtle soups. If you don't know what that is, it's okay. I'm gonna go over just right now too, just so I don't leave any cliffhangers, stuff like that. So the best time to look for these type of setups in London is 2 to 5 a.m. Oh, there's a helicopter going over. I'm gonna wait for it to pass by. Alright. This is for London. When you're looking for setups at 2 to 5 a.m., obviously it's because it's London session. If you want to trade Asian session, you can. MMXM models can happen. But honestly, it's not, the way I see it, it's not enough information of the day. My personal favorite time is New York session. I think most people love New York session more than London. London is mostly seen as a manipulation time. I'm gonna write that down. Mostly seen as manipulation. Manipulation can happen in New York, of course, and fractally, of course. Most of the time, New York is distribution. It's expansion, of course. So I'm gonna give you the sweet times, the best times to look for these setups. If you don't want to stare at the screen for 2 to 5, you can get on your screen, look around, you find a bracket. Oops. 3 to 4 a.m. This is the sweet spot. For New York, it's 9 to 10 a.m. These are the times when you really want to be looking at the charts. Most setups happen these times. I'll give you something else, another piece of the pie. If you see a high or a low made exactly at 3:30 a.m. or honestly 2:30 a.m., that is going to be a strong high or low. Like this. So if you see a high made at 2:30 a.m., that's already hit POI, it's done the structure, it's already crashing down. You want to follow this 2:30 a.m. high into your next POI. Just give an illustration on that. Something like this, right? This high was at 2:30 a.m. High. 2:30 a.m. And then you want to look for your market maker buy model. Sell model. Right here, right? IRL to ERL. The strongest times for New York, it's going to be 8:30 a.m. and 9:30 a.m. So if you see a high or low made at these times, it's strong high or low. Obviously, just change that to 2:30 a.m. or 8:30 a.m. So you see this model happening at 8:30 a.m. high right here. You're gonna have a higher probability. Of course, I can't say that you're guaranteed, right? There's no such thing in these markets. There's no such thing as 100% that I know exactly what's gonna happen. But in this way, you're adding the odds in your favor. Now I want to go over barometer times. So, give a disclaimer. These barometer times are mostly effective on Forex and indices or indices, however you say it. For gold, which is what I specialize in, I've been trading gold for 6 years now. Solely gold. Like I don't even trade EU, GU, none of that stuff. I'm in love with gold. I think gold is the best. It's if you want to make a living off of trading, honestly, it's gonna be gold or Nasdaq is what most people trade with too, right? SPX. But I do find gold to have very nice price action, in my opinion, and better expansion phases. Like to give an example on EU, if you're expecting a 100 pip expansion in your favor, you might wait 2 days for that to happen. You know, EU is really not that volatile. You might have a 40 pip day, 30 pip day, and that's pretty nice if you use a huge lot on that, right? But on gold, you can have 100 pips in like an hour if it lets you be. You could put a smaller lot size and catch a bigger expansion than you would on other pairs. But enough of my personal opinions. I'm gonna go with the barometer times. So I'm gonna put forex / indices. This is where it's most effective. So you want, like I said earlier, you want to be using 12 a.m. 1:30 a.m. and 7:30 a.m. These are barometer times. What do I mean by barometer time? Basically, under 12 a.m., you want to buy. Over 12 a.m., sell. Say the market opened up, gave us at 12 a.m. Now market's going down, right? Most people would be selling right here, which is don't really want to do. Knowing that the barometer time's right. Once you wait for it to hit some type of POI, then you can buy. Now we're above 12 a.m., right? So let's say there's another POI up here. Up here looking for sales. Most of the time, you'll also see that the day may close around the same time as 12 a.m. or the actual 18 o'clock opening of the actual candle. Honestly, I should say that the 18 o'clock is where mostly you're going to see price trying to head back to. 18, more than a 12. So obviously, the 1:30 a.m. you want to be using during London session. You want to be using the 7:30 a.m. in New York. So you can just swap these out. Use the same method of using these barometer times. Hope you're writing this all down. Oh. I need to go back just a little bit. Don't erase anything, of course, from your notes. But I'm going to go back to the IPTA slide. I need you to write this down, guys, on the IPTA part. So we've already gone through the phases, right? So how do these phases interact with each other? So there's a way of predicting the next phase if you can see the phase that's currently happening using IPTA. So obviously, if we're in accumulation, we're expecting a expansion. Into where? Just as earlier, into an OB, FEG, or whatever. From there, we expect a reversal. Is where most people are going to be trading at, right? Most people want this reversal part. Now it's a lot easier to see when this reversal part is going to happen, knowing that accumulation happened, expansion into these, now you have your reversal. So you want to write this down in your notes. Price always goes from consolidation into expansion. Price can go from expansion into retracement. It can go from expansion into reversal. It can go from expansion into consolidation. Price never goes from consolidation into reversal. I'm sorry, my alarm just went off. So, a couple seconds, I'm gonna end this part of the video, and of course, when it's uploaded to YouTube, I'm gonna have the other parts of the video stitched into this video. Finish this off. Price never goes from consolidation to reversal. This little part right here is what's going to help you frame a lot of your trades. You need to write this down on a sticky note, put it on the wall, memorize it, say it to yourself 100 times a day. This is how you want to see the market.